Good morning, everyone, and welcome to our DATIQ Weekly Market Update. This is our update for May 14th, 2024. That's actually my son's first birthday today. Exciting day for little Garrett. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and very special guest, fellow Big Tenor. We have Heather Dorn. Good morning, everyone, and welcome to our DATIQ Weekly Market Update. This is our update for...
Good morning.
We got a bit of an echo. I'm not sure what's going on.
Yeah.
All right.
Morning, Ken. Well, year's gone past fast, hasn't it, since Garrett was born?
I know. He was born on Mother's Day last year, which didn't fall exactly this year, but he turns 1 this morning, and that's exciting little times.
Right.
I'm not sure what's going on. Fourth and final.
Right. Yeah.
So I think Heather's having a little audio difficulty there. I think while she gets that resolved, we'll let them sort that out. I'll get to the key points of the week, and then we'll bring Heather back in for an intro and for our question of the week. I think that's probably the best approach. Let's do that. All right, let's get to our key trends as we're in road check week. Drive-in and flatbed spot rates flat. Reefer heats ahead of Mother's Day. We're seeing some really interesting trends, which I'm sure Dean's going to click into. I spent some time over a cup of coffee this morning looking at rates. We're getting very, very, very close to year-over-year parity with 2023 in drive-in. So I think that's going to be something very interesting to watch over the next week and a half. Contract active dry rates down 1%, replacement rates down 1.2%. Those are getting very, very close to parity as well. Large public truckload capacity in Q1 down 15.4% since June of 22, 5 quarters of decline. You see imports up 4% month over month and year over year in April. China to LAX volumes do bounce back 15% month over month. It is road check week, and I saw this morning the remainder of the Francis Scott Key Bridge has been exploded. So it seems like they're making progress in Baltimore there on getting things reopened. I'll turn it over to Dean to walk us through the market update.
And all the cargo, but that's seen. Of course, road check week is on. In fact, it's been on for about a week. I noticed last week the DOT inspectors were out here in New England in full force at almost every rest area on 95 and 93. So looks like they're getting earlier and earlier each year. So let's start up our market update with a look at the dry-van load-to-truck ratio. Load post volumes cooled off a little bit last week. They're pretty much flat month over month, tracking about 4% higher year over year. Load-to-truck ratio down slightly to 3.67 in the refrigeration market. There was a prior week surge in volume. Normally you see about 2 weeks out from Mother's Day, a little bit of a bump in volumes, both dry-van and reefer. But load posts eased back a little bit last week, down 7%. Load-to-truck ratio dipped slightly to 5.26. And flatbed load post volumes were flat last week, almost identical to the same level this time last year. Sitting about 20% higher than in 2019, a poor year for most carriers. Equipment posts up slightly. So load-to-truck ratio ended last week at 17.0 exactly. Having a look at some of our markets this week, starting off in the Midwest, dry-van rates in the combined Chicago-Joliet market up slightly, averaging $1.84 per mile. The last time outbound rates were at this level was in May 2020. Last week's average is a penny per mile lower than 2020 and about 2% higher volume of loads moved compared to that time. So regional loads, a lot of regional freight out of Chicago, Joliet to Minneapolis. Loads average $1.89, up 5 cents a mile week over week. Loads east to Detroit in the opposite direction, up 5 cents a mile to $2.47. In the dominant southeast warehouse market in Atlanta, rates up 5 cents a mile last week on a 3% lower volume of loads moved. And on the number one spot market lane out of Atlanta to Lakeland, rates were 5 cents a mile lower last week, averaging $2.38. Los Angeles capacity continues to tighten. Outbound rates up for dry van for the fourth week, averaging $1.72 per mile. Lots of activity, of course, in Miami last week, Mother's Day floral shipments, plus a record weekly shipment of strawberries out of California boosted spot market demand last week. They pumped out about 9.8 million trays of strawberries. That's about 2,300 truckloads of strawberries ahead of Mother's Day. Volumes are up about 29% year over year. Lots of good produce volumes being reported in California, which is good for the freight market this time of the year. In the San Francisco market, where most strawberries are grown in the Salinas area, outbound reefer rates up 6 cents a mile last week to $2.18. Volume of loads moved was up 5% week over week. Regional loads, Los Angeles from San Francisco, up 15 cents a mile to 225 on a 15% higher volume of loads moved. In the big Fresno market, outbound line haul rates have been steadily increasing since the start of March. Again, that's seasonally normal to see this kind of lift. They averaged 220 a mile last week. Remember, folks, these are line haul rates excluding fuel. Another busy lane out of Fresno is Phoenix. Loads paid carriers on average 239 last week. That's up 9 cents a mile, but still about 20 cents a mile lower than last May. Ratecasters has rates ending May around 9 cents a mile lower this year at 250 on that lane. So looks like we've seen the peak on that particular lane out of Fresno. In the flatbed market, having a look at the southeast market, the volume of loads moving across the southeast is almost 30% higher than this time last year. Line haul rates were up 4 cents a mile last week. They're averaging $2.52 a mile for outbound loads. Carriers are paid on average in Atlanta about $2.49 a mile. That's 8 cents a mile higher than last year on a 24% higher volume of loads moved year over year. That's outbound Atlanta. Most outbound Atlanta flatbed is destined for Lakeland, Florida, another big flatbed market in the south. Line haul rates averaged $2.63 last week. That's 5 cents a mile higher than last year. And in our market update this week that's published this evening, we've been tracking a lot of the break bulk steel tonnage that comes into New Orleans. On the Gulf Coast, a lot of that is boosting load volumes. Loads moved up 2% week over week. Still plenty of capacity, though, in the flatbed market along the Gulf Coast. Rates down 3 cents a mile, outbound from New Orleans to 246 a mile. One of the high volume lanes for flatbeds out of New Orleans is Houston. Loads moved were the highest in 12 months, averaging $2.77 a mile. Loads moved up 18% week over week. On the New Orleans lane to Dallas, rates were down 15 cents a mile to 238. Wrapping up our market update with our year-over-year look at spot rates, the national average dry van line haul rate remained flat last week, averaging $1.57, 3 cents a mile lower than last year. And on our top 50 lanes, based on the volume of loads moved, those top 50 averaged $1.87 last week, 30 cents a mile higher than the national average. And in the refrigerated market, rates are up for the third week. Last week, up 2 cents a mile to $1.91. That's 5 cents a mile lower than this time last year, and about 5% lower volume of loads moved. And in flatbed, line haul rates were mostly flat for the third week. They're averaging about 203. The national average is about 10 cents a mile lower than last year, and volume of loads moved is about 8% higher. So similar trend across most markets reported this week. So that's it for our market update. Don't forget the long form version of today's report with charts and associated commentary will be at dat.com/market update this evening. Over to you, Ken, for the short-term forecasts.
Thank you, Dean. So this week, as always, we're going to take a look at the short-term forecasts. We always start with dry van. The blue line is the historical 7-day weighted moving average excluding fuel. So that's a line haul only proxy. And then we have 4 forecast models. We have green, which is Raycast. That's our flagship model in all of our products. We have red, which is a short-term model. For lack of a better term, it tends to freak out based on short-term price movements. And then you have a yellow and a gray, which are intermediate models. They kind of blend both a short-term effect and a long-term look. I think what you're seeing here is pretty much all of the models behaving as intended. Raycast shows some strength heading through Memorial Day and then starting to plateau a bit. That red model picked up, a week and a half, 2 weeks of slightly elevated rates, and it's taken it off to the moon. And then you've got some tempered expectations in the middle there. Let's go to refrigerated. You're seeing more pronounced you're seeing a longer run up in rates going up, which is everything Dean talked about with produce and shipping and whatnot. So Raycast has that going not quite as far into the month of May, into June as dry van, and then subsiding a bit. The other 3 models are in pretty tight agreement over the next 3 weeks. and then start to diverge a little bit as we get, like I said, towards the end of May. Let's wrap up with flatbed, where we see a ton of model agreement. This is one where you see ratecast actually above the short-term model. So it has strength permeating into the end of the month and then plateauing a bit, where the other models don't. They see this rally losing a bit of steam here in the next 2 weeks, and starting to flatten and pull back a bit. That's our review of short term. Now let's bring Heather back for a proper introduction and what I'm assuming will be a lively discussion. Welcome back, Heather.
Hi, thank you. Sorry about the mic problems. Technology.
That's not even the top 10 worst technological difficulty we've had on this program, trust me.
Well, you think I'd be used to these by now after, a few years of Teams and Zooms and everything else, but
3 years in, I think the most popular business phrase is still, you're on mute.
Right. That's true.
So Heather, can you give us an introduction to yourself?
Sure. Thanks for having me. I'm excited to be on the show. My name is Heather Dorn. I'm the Executive Vice President and Chief Commercial Officer at Dorn Transfer Company. This is a family company. My great-grandpa started in 1921. The company was sold at that time. My dad restarted it in 1981 with public warehousing and then restarted the trucking from there. We are based in Rock Island, Illinois, and 10 years ago, we joined the Pitt, Ohio Transportation Group. So we're also part of that team of companies, which includes Pitt, Ohio in the Mid-Atlantic, Ross Express out east, and U.S. Special Delivery up in northern Wisconsin and Michigan. So I've been in the industry for 30 years, which I know that makes me sound awful old, but it's true. I cut my teeth when I was 16 in customer service. Went to school. When I got done with my degree, I came back and started in sales. And from there, I also started our marketing department. And I now support our sales, marketing, customer service, IT, pricing, and finance departments. So I'm responsible for everything of how we go to market and how we take care of our customers and all of that. So thanks for having me.
Yeah.
Thanks for coming. Dean, you want to tee up the question of the week? Because I think it'll be a really good one.
Yeah. I was looking on your website, sort of getting an idea about what sort of things to talk about after we spoke at the Journal of Commerce Inland event last year. And it sort of struck me about the range of services that Dorn Transfer offers. So my question in the week would be, with such a diverse range of services, is there any one sector at the moment that's outperforming the others at Dorn Transfer?
So being part of the Pitt, Ohio Transportation Group, we do have quite a few different areas that we cover. We really go to market as a whole logistics solution provider. The Dorn Transfer piece of it, we were kind of grown in LTL in the Midwest market. And I would say that by far our LTL division in both the Midwest and the Mid-Atlantic is doing phenomenal right now. And I think I attribute that to everything that happened last year with the YRC and customers kind of having to reshuffle quickly into the national carriers. What I'm hearing more than ever from our customers is that they really value that regional connection. And that's something that Dorn Transfer and Pitt, Ohio really excel in, because we can go to market as a regional carrier with that regional touch so that our customers are a big fish in a small pond, but then we have a super regional reach. So it's really, we're kind of giving them the best of both worlds. And when you look at all of the reportings of the public companies, a lot of them are kind of slower in their growth right now. And Pitt, Ohio and Dorn are both seeing the opposite of that. We're seeing really nice growth year over year. Revenue up, April we had a lot more days this year. So the actual whole month was up 20% in revenue. But if you look at the daily revenue, it's up 10% year over year. So we're doing really well. We're growing nicely. On the Dorn side of things, we are based in the Quad Cities, which is also the headquarters of John Deere. So as you can imagine, we're very heavy into the ag area, and ag is not doing as well right now. They're selling parts well, they're not selling the machines as well. So we're seeing that business down about 20%. So the fact that we can still be up 9% year over year, even with that huge decline in the ag area, really speaks to how many customers I think have shifted more towards the regional carriers and away from maybe more the national carriers, or even diversifying, because they had too many eggs in one basket before.
Heather, are any of the agricultural dealers in your area, whether they be, hay baling or tractors or, combines, have they been impacted by the the Baltimore Bridge tragedy that happened a while ago?
Not that I know of. That, a lot of what we handle for them is all the regional type business, and they're so heavy just in this region. The other thing we're seeing growth in with the ag is nearshoring and reshoring. So there's quite a bit of business that's now moving across the Mexico border. John Deere, in fact, has their own lane between here and Mexico. That's how much freight they have moving back and forth. And so a lot of the business that we see shifting is coming more into consolidation and distribution from the Mexico business coming over, and Canada as well.
Got it. Is there, with the growth that you've seen in the last year, is there a shift in commodity type or consignment size in the LTL space?
So our shipment size, the actual tonnage, is down. Year over year, it's down quite a bit. Now, if you look at, month to month, it's starting to really level off. I think a lot of that you can attribute to the truckload market being so low that some of that LTL business has shifted into truckload. What we hear from a lot of our customers is that they are a little bit slower. We're seeing growth in bill count and customer number, but maybe less freight per shipper. And I think there's just a lot of uncertainty right now. What we're seeing in the manufacturing PMI, it's over 50 for the first time since 2020. And so the expectation is that things are going to be picking up. But I think everyone's just kind of, we're a little slow right now as far as each one of the shipments. And the weight per shipment.
That was part two of my question. I'll sort of let Ken jump in here on the LTL piece, but on our load boards, we'd been seeing a lot more part loads in truckload configuration. So the shipment size was getting smaller, and we're seeing more multi-pick, multi-stop loads, which, of course, for carriers, irrespective of the rate per mile, aren't necessarily profitable if you're under a 800-mile load for 3 days. That really doesn't add up. But that's the nature of the business right now, where demand is pretty slow and capacity is still very much available.
Yeah, I guess that's where I saw a refined org chart, not an org chart, a distribution of what the LTL landscape looks like post yellow, right? That was the big story last year. How are you seeing any lingering effects of that, or has it just basically, did it happen at the right time for the industry to just absorb all of that?
Well, when it first happened, I think we saw there was a lot of panic. The thing was that it was such a slow closure that I think the freight was able to find a home immediately. What we're still seeing, I think, is that customers are still shuffling that business and trying to find the right fit and trying to get the right mix of regional and national carriers. And you see the carrier landscape changing too. So if you look at like a Knight Swift that used to be, several regional carriers, that's starting to morph into a national carrier. The capacity piece of it. So right now there seems to be enough capacity because I think customers are a little slower. But what I see happening is, those yellow terminals, a lot of them were purchased, but some of them aren't going to be reopened as an LTL terminal. And the cost to build and regulations to try to get permits to build for LTL companies is very difficult right now. So I think that you will see a capacity crunch as things start to pick up a little bit. And what I'm seeing with LTL carriers is just this kind of this scramble to see who can get the real estate to make sure that they're in place and ready to go as soon as things do start to tick up more. But I think, in the beginning, it really was not as disruptive as you might think of one of the biggest carriers going out of business, just because it hit at the time where everything was really starting to drop for us last year at this time.
So I'm not just saying this because you're on. We have a few connections with Pitt, Ohio. We know Jeff Mussig, who's the EVP, and actually small tangent. A guy that comes up to our hunting camp has been a driver and is now a trainer, and he's been with Pitt, Ohio for something like 40 years.
That sounds typical.
Yeah, Glenn. And I've never heard anyone really say something negative about Pitt, Ohio. And it's kind of the way with a lot of regional LTLs. Dean and I talk about this a lot. Dayton Freight Lines, a bunch of these regionals seem to have, which is in pretty stark contrast to how a lot of national LTLs are not viewed necessarily favorably. Short of Old Dominion Freight Lines and now XPO with the Brad Jacobs turnaround, national LTLs aren't like the bastion of operational excellence typically. Why do you think, is it more customer intimacy with the regionals? What do you think drives that?
Yeah, I think it absolutely is. It's personal touch. And like I said, our customers are big fish in a small pond. And so, we care about each one of them. You don't have to be one of the biggest customers to get attention from us. Our transit times are faster. So, you've got a lot better reliability. And then the other piece that a lot of national carriers won't talk about is that they pass a lot of their freight off to regional carriers. So you may be getting a story that they service 100% of the state of Missouri, for example, but I can tell you that most of the national carriers pass off part of Missouri to companies like us. And so when we have our hands on your freight, and I think the other shift you're seeing is that the regional carriers, a lot of the smaller niche carriers have kind of disappeared or got acquired by a bigger carrier. And so the size of the regional carriers, at least for Dorn Transfer in Pitt, Ohio, we've got enough of infrastructure that we can really invest in technology too. So you don't lose the trackability piece of it. We were one of the first carriers to roll out to market electronic delivery receipts. We did it during COVID when things were easy to kind of implement quickly with technology. But on the Dorn Transfer side of things, we are a small enough carrier that all of our customers, we know our customers well, we know their needs, we know when they shift how we need to be ready to meet their needs. But we also have the technology to have a photo capture from pickup all the way to delivery and to be able to give them updates and push out information proactively. So, they really get the best of both worlds. And carriers like the Pitt, Ohio Transportation Group, we've gotten really good at operating as regional carriers, but then working together behind the scenes. So it's a seamless interaction. If you want to ship from Nebraska to New Jersey, you've got all the live updates, and it's in the same company, the same family of companies, but each regional carrier gives that personal touch. And I think I've seen Dayton is a fantastic company too, and you see them operate with that same type of personal touch. So that's just my opinion, speaking from a regional carrier point of view. I may be jaded.
No, I think that explains a lot. It's also harder, right, to implement these things at scale. I remember I was at FedEx, our subsidiary rolled up under FedEx Freight, and like roll out dimensional weighting at a regional versus coast to coast. That's a much different project spanning multiple years, and especially if you're a union shop. I don't know why I keep getting these random thumbs up on my screen.
You're doing this.
Am I? I know if I do this.
There you go.
So I don't know what's going on. But yeah, that was one of the things that I always thought about. Was like if you had 100 terminals versus 1,000, the scale at which you can make change. And I think that's ultimately what doomed Yellow, right? Mm-hmm. Was for a lot of different reasons, they weren't able to adapt quickly, and it bit them in the end. So
Heather, when I first moved from Australia about 20 years ago, I was struck by how inefficient the LTL loading process was when I was on a roadway dock in Harrisburg. And the whole idea of 28-foot pup trailers, and you'd have to, spot one at a time, and they weren't load through, for example, with roller doors on the front and back, like all of these sorts of ideas I had. But I was just watching drivers manually load freight. And I wondered about how much has changed in your business. Like I hear and see reports of, I think you call them freight dimensioners, or something that, actually can create some sort of a image of the freight in 3 dimensions and figure out how to load the trailer best. Is that something that you do every single day now?
Well, we use dimensioners to understand the freight well, but we aren't using the dimensioners to load the trucks. And if you think of just the environment of the LTL environment, to some degree, you're going to have some waste just because our freight moves so fast that, the majority of our transit territory is next day. And so to get that to happen, it's frankly a miracle that you can move freight that quickly. We do a good job of loading out as much cubes as we can on our line haul trailers. We use decking sometimes if there's space above it. Yep. But unlike the long haul carriers, we're not going to break the freight down, take it off of skids to cube it out, because for us, the most important thing is the time. We've got to keep it moving and get it to the next destination so it can get out for delivery. But most of our terminals are loaded by dock personnel, and they've got scanners. And so there is a lot more technology behind the scenes trying to make sure we're finishing those loads. And then we even use load photos. So, we're taking photos of every load when it's closed. And we've got people here who watch that information behind the scenes and at night, and they're recalculating where we need to move our capacity. But in our environment and the LTL environment, it moves so quickly that it's hard to project from one day to the next. So we have to use a lot of analytics and some guesses, and hope that our customers give us good information. our best customers give us good projections. So in that case, we are using the technology to make sure we're going to max out the trailers.
Right.
But we have some customers who can't do that for one reason or another. They don't know what they're going to have until it's too late to be able to give us a projection. And in that case, we work with them as best we can to try to make sure that those loads get filled out.
I guess one of the questions I had was about the technology that was announced last year. That was sort of like imagine a pod that's 27 feet long and 7 feet wide that you slide into the trailer, but you preload it on the dock from the side.
Mm-hmm.
And of course, that works in new warehouses where you can allocate the space, not so much in an LTL, where you've got one in one side, out the other.
Right.
Does that have potential in LTL, sort of a pre-consolidation type pod?
It would be more difficult for a company like us because we deal with such odd freight. So again, I'll go back to the ag just because we're in the heart of the Midwest. I mean, when you've got augers, which ship on our trucks, there's no good way to get that to cube in there. And something like that would be a little trickier for us to use.
Yeah.
But you're right. It would have to be more of a new dock situation. And then that requires building new docks, which is very difficult.
Yeah. I was in Australia in February and did a little bit of driving. And one of the things a lot of people don't know is a lot of freight in Australia moves LTL, but it's not rear load; it's all side load because of the availability of space. But the side load of LTL is on triple floor trailers, so they've got adjustable mezzanine floors in the trailers where you can put your auger right at the top, and then with a forklift move the top deck all the way up to the roof, and then put 2 full pallets of deck freight in underneath. So the consolidation's fairly good when you can load from the side, but it's fairly hard when you load from the rear to actually get, every single cubic foot of space occupied.
Yeah, that's true.
Yeah.
So it's probably shocking for you to come here and see the difference, right?
Yeah, and like you've only got 2 trailers on or 3 trailers. Like,
yeah.
Yeah, very different task. But anyway.
Yeah.
All right. What do we got, Ken? It kind of brings us up close to the end of the show here.
I don't have anything else.
Okay. Heather, where can we see you next? You mentioned CSCMP before we came on air.
Right. So CSCMP, Jeff Busick, who's the EVP at Pitt, Ohio, and I are co-chairs of the Transportation and Logistics track. Right. So we've got 3 really good panels. We have one on AI, one on more of the nearshore surface transportation, and then just kind of an industry update from the LTL, truckload, 3PL space. And we've got some fantastic speakers on those. So that's in end of September 30th is the day of ours, and that's down in Nashville.
Okay, good. Well, no doubt we'll connect there. I've got a couple of shout outs, Ken. Robert Rouse, we're on Landline every Wednesday evening, 7 p.m. on Sirius XM. Don't forget the next issue of Freightvine podcast that's out this week. Our very own Professor Chris Kaplis is talking to Matt Waller from New Roads Capital Partners. He's from the University of Arkansas, talking about the retail value chain and how much it's changed over the last 30 years. It'll be a fascinating show. On next week's show, we've got a small fleet owner and a good friend of DAT, Josh Rickards. He'll be on our show next week, so we're looking forward to that. And of course, we're all off to our symposium this week in Hilton Head, South Carolina. What else have you got on, Ken?
I'll just reiterate and give Heather a chance to flash up how they can get a hold of her or her company's services. I think based on this conversation, folks are probably going to be beating down your door to get in touch with you.
I hope. So our website's www.dorn.com. And then my email's easy, hdorn@dorn.com. So as long as you spell the Dorn right, it's easy.
Awesome. Well, thank you for joining us. I'd love to do this again sometime in the fall as we gear up for peak. That'd be something I think to have a great conversation. Maybe have a little more football talk in there. Maybe we'll get you on right before the Iowa-Ohio State game and we could do a swag swap challenge.
Yeah, sounds good.
I've done that before. Other than that, I have, like Dean said, we'll be in Hilton Head, South Carolina for our executive symposium this weekend and next week. It should be a really great event. Play some golf, have some great topics to discuss. And then we really start turning the page into the fall. We can't start talking about this early enough, but we have DATCon in the fall. We have TIA Technovations, CSCMP, JOC Inland. I think so. Attention's really starting to turn on the fall there. as we gear up for that trade show season. But with that, we're going to sign off right on time here today. Hope everyone has a great week. Again, remember, it's Road Check Week out there. Be safe. Always be safe, not just because it's Road Check Week. And we will see you next Tuesday at 10 a.m. Eastern. Bye, everyone.
Bye.
Bye.